Thanks, and good morning, everyone. My name is Patrick Laub. I'm at the University of Melbourne as a postdoctoral researcher, and it's 1:30 in the morning over here, so that the time's not ideal, but in a metaphorical sense, this is a great time to give this talk because the paper that I'll be describing the results of just got accepted to IME, and we just also pushed the Python package to the pip repository as well. So what the talk is about is a kind of Bayesian statistics. So this will follow on very nicely from yesterday's keynote about PyMC. So PyMC is using underneath it an MCMC framework, and like most of statistics, it relies on us having a likelihood function for our model. And for lots of models, and this is tractable, but it's easy to find models where the math just doesn't work and you can't easily get a tractable likelihood. I mean, a very simple example is if you just add two random variables together, then the resulting thing usually has an intractable likelihood. However, it's still possible to simulate from these more complex models that the traditional statistics breaks down on. So I'm going to give just a very brief introductory example about how the ABC way of fitting coin flip data. So imagine that we have a biased coin and we flip it 3 times and we see that we get the data heads, tails, heads. And we want to find out this theta, which is the probability, the bias of the coin. So the ABC way of finding this posterior is just to start flipping coins. So what this simulation is doing is it randomly generates a number for the bias, say 90% bias heads. It starts flipping coins, and with 90% it'd be heads, heads, heads. And it compares this fake data against the observed data, the real data. And when they're the same thing, then we say, okay, that potential parameter was a good fit for the data, and we keep it. And if it was wrong, we throw it away. Of course, this fails pretty quickly when you have larger sample size. So the exact same problem, trying to fit coin flip data, but now we've got 8 coin flips. Just doing this thing of randomly generating a biased coin and randomly flipping that coin 8 times. After 100 attempts, we never see the observed data, which is where the A in ABC comes from, the approximate Bayesian computation. So the approximation is we accept fake data that's pretty close to the observed data, and that way this becomes a tractable problem. So what does this look like? If this is our posterior distribution for the data, maybe we allow ourselves 1 unit of error, and we get the posterior, an approximate posterior, which is this orange curve, which is pretty close to the real one, and it takes a lot less computational effort. And then, of course, when you keep increasing your error budget, the thing breaks down in the limit. The way I'm showing this is sort of the perfect solution getting worse, but in fact, the actual algorithm kind of works in the other direction. It starts with a bad posterior, does some simulations and generates a better one, and then does more simulations, and it keeps going until you're happy and you can stop. So in the insurance motivation we looked at was fitting a loss distribution approach. So we have a random number of claims coming in, and we have a parametric model for that with a theta frequency we want to fit. Each claim is a random size, and we have a parametric model with a theta severity, but we're assuming we don't see the whole data, we only see some summation of it. So for example, each month we see the aggregate claim size, or the size of the largest claim, or the stop loss. And this means the likelihood is intractable, and we're in the ABC world. I mean, I'll skip over the boring math, but basically it says that this whole approach works in theory. We extended it slightly for our case. And I'll just quickly blaze through some simulation examples. So here is data that's come in from a Poisson distribution. The claim sizes are dependent on how many claims there are in that month. And these are posteriors for the model parameters, lambda for the Poisson, beta and delta for the dependent exponential. And to make a long story short, these curves being on top of the dashed line, which was the true value that we used to simulate the data, is a good thing. Here's a different one where we're assuming that we have a time series that we observe. So the intensity is fluctuating up and down over time. And ABC can handle that as well with a bit of effort. And to keep in mind, even when you have the real parameter that generated the first data set. I mean, if you generate more data from the same parameter, it's not going to be the same thing. So this is quite a hard problem. And a larger problem we looked at was bivariate data, where we imagined, say, two lines of business, two insurance lines, which had a dependency between them, and how would you fit that complete model? And we had some success there. Okay, I'll be wrapping up. Sorry, 1 minute?
1 minute left.
Perfect. At the main thing that I wanted to say is that the way to think about ABC is ABC takes a very hard statistics problem and then turns it into a very hard programming problem. And so I made a Python package for the ABC method that we used, and that's available on pip. So pip install approxbayescomp, and it's extremely fast and it's dedicated for the actuarial use case. I mean, I originally had heaps of slides about how I made it so fast, but I'll just call out the one library number, which I'm sort of fallen in love with, which takes a Python function, does just-in-time compilation to make it as fast as, tries to get it as fast as a C call. So we heavily relied on that. Okay, and I'll finish up by hoping, one of my take-home messages is I hope you sort of have a flavor of what ABC is now. Go check out the paper if you like, which is on archive or from my website, and check out our package as well on pip. Thanks.